I almost don't really see how we are able to build on this TradFi product without a risk infrastructure. Like, we don't have all those tools that in traditional finance you're used to see to understand risk and to trade it effectively.
Everybody involved in the Vault stack, everybody's talking about onboarding RWAs. Everybody is talking about moving into traditional finance, yield sources, assets, a customer base, etc.
We go through these phases where, now we are getting comfortable with more and more risk, etc. And inevitably this leads to blow up. So I think we've seen how much we need a risk infrastructure.
With more capital, more institutions coming on chain. And I do think that, if we want to have adult capital in the room, there has to be a more mature approach to all of this.
Tools that allow you, for example, to auto loop position through a limit order style thing. This is really, really cool because actually you can build loops and unwind loops and make a profit.
Welcome back to episode 79 of the Odyssey Pod. Today we are joined by Luca, who is the co-founder of Telos and of Cassa. How are you doing, Luca?
I'm doing fantastic. Thank you very much for having me. Glad to be on episode 79.
Thanks for coming on. So I think you're our first Italian, if I remember correctly. What got you into the space and how did that ultimately lead to founding Telos and Cassa? And can you shed a little light into what you guys are doing?
Yes, with great pleasure. So my background is actually in telco. That's where I used to work before deciding to fund my own company. Thankfully, it's a company that went quite well. So I was looking at ways to essentially place my treasury, and that got me quickly into crypto. Found very interesting the value proposition of crypto. When I joined, DeFi was not existing in 2016. Right? It was talked about, this thing that's going to unlock massive new opportunities, and so I followed very, very closely. It was extremely interesting to me. So much so that in 2021, I decided that I wanted to jump full time into crypto. I hired a CEO for my other company and started, what is now essentially Telos Consilium. We are a growth and a go-to-market firm that's really focused around pegged assets and stable coins. We've helped a few projects with various things, especially in our origins around liquidity, but also, enabling connections, deal flow, etc. Last year, after two particularly successful launches, we realized that, the best path forward for us was to stop serving other projects and actually start making our own one. So I spun up a technical team. I partnered with a very strong CTO, which is a quant software engineer with a very strong background also in managing risk for insurance, managing, $18 billion portfolio. And our first opportunity actually was not really, to directly work on our first original protocol, but was to work with Euler. It's a team I always deeply liked and respected. We had done already some stuff with Euler View. We obviously saw the resurgence as it was happening. And that was quite impressive to see. So when we had this opportunity to work with them, we jumped onto it. We helped a lot with Euler Swap. I think still today we are the most proficient team when it comes to Euler Swap in the world, outside of Euler themselves. We have built so much infra around it. A tool that allows you to set up delta neutral positions when you do pools that in principle have impermanent loss, like Ethereum USDC. It does an instant hedge on Binance. Last summer, this tool was doing really well when the funding rates were better. Then we've also done other kind of tools that allow you, for example, to auto loop position through a limit order style thing. This is really, really cool because actually you can build loops and unwind loops and make a profit, right? Usually you're considering those things as something that makes, price impact, you lose value, sometimes there's poor liquidity, you feel like you're stuck in the position. But no, with Euler Swap, you can actually have solvers fill your order, fill your loop, or, deleverage you and make a profit. So yeah, that's really, really cool. But anyways, that obviously led us into the curation scene. We saw a few opportunities to do that in August. So we opened Telos C. They're actually a separate entity. I'm essentially the only, link between the two. And that still has some products live today. And famously, a couple that were affected by the stream finance situation, which were also, unfortunately, the ones that grew the most. And what really puzzled me is that during the month of October, we had just started curating in August. So in October, we had those two products on Plasma. One was called Telos Surge, which was, as the name maybe suggests, a little bit more aggressive in terms of its allocation, and obviously was exposed to stream. And we had Telos Haven, which was more conservative, but in our opinion had preferable risk-adjusted returns. But we realized we had no way to essentially show that to users, right? And users only cared about the more performing vault, like the disproportion vault was really crazy. Like the Heaven vault, I think never really got more than 10, 15 million in TVR, while the other exploded at some point. It was 320 million in TVR. And so this led us to re-explore a project that we were already eyeing out, and that immediately after the stream blow up, we realized how much this is needed. I actually really would have loved to have it. I think we're very, very positioned to say this even more now. It's really improper to judge curators on just TVL and APY. You need a way to tell them what are the risks, and UIs on lending markets, I think, in all cases, do a poor job at that. So Cassa is what we're busy with now, and it fixes this by essentially being an infrastructure that prices risk and tells you, what is the risk adjusted return of this product. If I have a vault that yields 9%, but the risk is priced at 8, my vault does not deserve to exist. It's really bad. And instead, if I have a vault that yields 6% and the risk adjusted return is fair, right now the users would be incentivized to go towards the vault that yields the more because they cannot really understand, that it's also higher risking and the risk management is poor. So now with Cassa, instead, they're able to choose the product that has better risk adjusted returns. But I think more importantly than this, curators that plug Cassa in their products, they are themselves able to optimize for risk adjusted returns rather than raw returns. And this is something that pushes the space forward, other than a lot of very interesting things that we're very, very excited about. So hopeful to talk a little bit more about them. Sorry for going on this monologue, but hopefully I gave enough context here.
Yeah, maybe you can dive a little deeper into how you identified the opportunity of curation needing risk management, because I think from a retail or pro-tail DeFi user perspective, many people do not really know who these curators are that are managing their strategies. And from what I've seen in the DeFi trenches, curation as a narrative and as a big thing emerged very suddenly in early to mid 2025. And now everybody talks about curation, everybody talks about vaults. So can you, since you've been involved in that game of curators for quite a long time, can you describe who these people actually are that are doing curation and what necessarily qualifies them or maybe doesn't qualify them, like create the need for more standardized and institutionalized risk management? And yeah, which of the curators were able to rise to like power and high TVL through which methods? Is it necessarily the best one, or is it just a BD and growth game? And yeah, how did that entire race work?
Man, do you have the whole day? I mean, we could talk about this forever. Honestly, this is such a broad topic and a very, very,
You're
very
open-ended.
exciting one. So yeah, you mentioned so many things. I don't even know where to start. So, obviously when you do curation, yes, you're doing risk management, but you're also trying to run a business, right? So you also, yeah, obviously you want to have the best risk adjusted returns, but every time there is a reward, there is also a risk. So, this is inevitable that it is part of the business, right? So whether, whatever is your opinion, given a long enough time frame, a risk event is bound to happen. And so how do you conciliate, this with what, a lot of people think? A lot of people think if I delegate my money, nothing ever can happen to it. And the curator is responsible for it. And it's their fault if I lose it. Well, in reality, every time there is a risk, there is a reward. And so users need better tools to actually be able to make those decisions. And because they do not know who are those people.
I found that very interesting, like post the stream incident where people were acting like, oh, but the vault I deposited into was run by a curator. They're supposed to manage risk. And like suddenly DeFi participants in like one of the most experimental industries of finance are now acting as if risk management is equal to risk like elimination, which is not true at all.
Yeah. I mean, anytime you have a reward, you have a risk, and nobody can abstract that from you, right? So the only thing you can do is to see it. If you're able to price it, if you're able to see it in an objective, measurable way, I think it makes more sense, right? I think it's a bit dangerous to only show the raw returns and to have curators optimize for higher raw returns. That's what was definitely broken then and still is broken a little bit today. So we definitely need this risk infrastructure that allows you to price that risk. But again, even with the risk transfer infrastructure, well, actually, yes, you're able to cover yourself against that risk. But the fact that you can see it priced allows you to understand which products are better and which ones are not suited for you. So, but then, curation by itself as a business is not as profitable as people may think. Like, you really need a proper team, to run those products. So you need devs, you need quants, you need very expensive monitoring infrastructure. You need ideally someone around the clock, that ideally runs, stuff on MPC wallets. It's really not the thing you can bootstrap in your garage. And it's often, from what I've seen in the industry, hardly something that's by itself profitable, especially for the smaller curators. And that's true also for us. It was more something that we thought could add value to our growth and go-to-market services, especially now that stable coins are able to essentially capture so much value from being listed in lending markets. We thought that if we are a curator, we can help with our growth and go-to-market value proposition, and also do cool products in DeFi, right? Because let's not forget, another great thing about DeFi is also that I've been here since the early days. I like to believe that we are sovereign users, right? We can do what we want with our money. If there is a product that's yielding 1000% and I deposit into it and then my money disappears, it's my fault. But I have the right to do this. I have the right to use a more degen product to have, and unfortunately this doesn't marry very well with the curation ethos, right? The idea with curation is more that you're catering to more passive users, to users that are a little bit more sticky. They are happy to get exposed to the yields of other products, but are not interested in running complex strategies or doing loops, etc. So they're really just trying to be lenders. So yeah, this is again a big shift that we're seeing in DeFi, and maybe we're seeing it even more this year. That RWAs, managed products, are becoming more and more prevalent. But again, the curation, unless you're talking about gauntlet stakeouts, is really not just profitable by itself. Those are usually folks that use it as a mean to achieve something else that they're doing that's more profitable, and or they're just running it as a startup. So essentially accepting that they're burning cash because they're so bullish on this vertical. Like we've seen how how much TVL you can acquire from plugging into neobanks, plugging into infrastructure. I'm not super bullish as vaults, earn vaults in particular, as the only vehicle for yield infrastructure. Actually, one of our clients is Money, which is really building deep into yield infrastructures for neobank. I think those are a lot more interesting products than just simple vaults. But yeah, to each their own, right? That's the beauty of the space. We have a lot of choice now.
Since you're very much at the root of a GTM strategy and approach of many of the curators, I feel over the past couple of months, especially ever since the downturn in October, we have seen kind of a divergence in how the industry wants to position itself and how it is perceived by the depositors and the actual participants. If I talk to vault curators, I notice that a lot during ETH Denver, and everybody involved in the vault stack. Everybody's talking about onboarding RWAs. Everybody is talking about moving into traditional finance, yield sources, assets, a customer base, etc. Yet it feels like what you see on chain, what is discussed, and like what the final market participants are talking about and devoting attention to is still very heavy on the crypto native and DeFi native side. So how would you say these GTM strategies have evolved, and like where would you say can you judge if a wallet provider is going to be able to evolve into TradFi and like onboarding more serious and more sizable capital? And do you even think that for the DeFi native capital, this is a large enough market for the other ones to survive?
Well, yes, that's a great question. I think lending markets are really uniquely positioned to capture a lot of value from these integrations, right? Like, so for example, let's say you are a subscriber to a private credit product in the traditional finance world. It's very hard for you to get leverage on it. Let's say also you have maybe tokenized equities, maybe even tokenized shares of pre-market companies like Revolut, like SpaceX, there's really not much you can do. So the value proposition for everybody tokenizing those things is that suddenly plugging them in DeFi is a terrific distribution angle. You can do, with the financial tools available in DeFi, something that in TradFi would just take you years in regulatory work to get through. And then even if you could, right? I don't know if you ever tried to borrow against, your equities unless you have a meaningful size, it's quite complex. And after that, the LTV is absolutely horrendous. The interest rates are not often ideal. Now in DeFi, we're seeing an environment of very, very advantageous lending rates. And so actually leverage is quite cheap at the moment in DeFi. So there is a lot of interest in seeing this go forward. But again, as a curator, you need again a new expertise, because I feel there's big misunderstanding. People think that, because it's a real world asset, it's tangible, it's out there in the real world, then it's essentially a risk-free thing. But the reality is quite the opposite. All of those private credit products are quite degen. People don't realize that, triple B is considered, the limit between something that's not yet in like the speculative territory. But even then, we are observing quite a bit of defaults, and even more now that the geopolitical situation is so uncertain. And again, we have no way to measure what is the risk here. Those private credit products have a very dynamic risk profile, changes essentially every new allocation. And because it's such a hot industry, so much capital is flowing into it that those asset managers have really, to push up the risk ladder to essentially just satisfy the demand. And this is in a way something that similar to what broke DeFi already, a couple of times, right? We've seen those cycles over and over again. Essentially, users being comfortable with a certain set of risks, then going just a little notch up, then, a blow up happened, like UST, right? 20%. So we understand 20%, we are now understand that 20% yield maybe is not as safe as I thought, especially if I loop it on magic internet money 8 times, right? And so again, we go through a phase where we're very risk averse, where we, only care about the safe products, where we talk about safe DeFi being, and I fully agree with those values. It's obviously very bad when people lose money, and when this really affects people and hurts the people in a very meaningful way. And I think people that don't realize this don't have space in this industry. Right? But then again, we go through these phases where now we are getting comfortable with more and more risk, etc. And we and then inevitably this leads to blow up. So I think we've seen how much we need a risk infrastructure. If the October events taught us anything, is how important transparency is. Now, I think curators had a lot of transparency. So, if there is crime in the end, crime is going to happen. Unfortunately, there is very little you can do to mitigate against that. But transparency is great, because once you see through something, you can then price its risk in a more suitable way. So I really like, for example, what Curators is doing, and they're working a lot also with RWAs. They're doing ratings. So they are defining a framework and then assigning a letter to a product that is meant to correspond to its perceived safety. So A is best, and then B, C, D, E, F for essentially trash. Now, what's fantastic about this is that you can see what are the risks. You can understand the product a little bit better. You can get to know the curator a little bit better, because you can understand their practices. But again, you cannot price the risk. And if you are going to tap into very volatile products in terms of the risk profile, like Fazanara, but like other private credit, RWAs, but even tokenized equities, which have legal risk, counterparty risk, you want to know more about this. So some people are doing tranching. Tranching is also another very cool vertical, because it allows people that want to receive higher returns to be just simply exposed to higher risk and get them. I really like this solution. It's quite elegant. Unfortunately, again, it does not tell you what is the price of the risk, but it does serve a useful purpose. Lastly, this does not exist, by the way, yet, but Euler team mentioned to us that they had thought about it. Those vaults, they work in a way that anytime somebody withdraws, let's say, those more for earn vaults, every time there is a withdrawal, this withdrawal happens as long as there is available liquidity, which shifts very much the allocations, right? So let's say I allocate to 3 markets, 2 are healthy, 1 is under stress. So because this market is under stress, all of the users are incentivized to withdraw, but the liquidity will be pulled out of the healthy markets, meaning that every time liquidity is pulled out, the users that still have liquidity left are overly now exposed to the non-healthy market, and their losses in a way are potentially amplified. And so this design is great in terms of UX, in the sense that, as soon as there is liquidity, I can withdraw it. But in terms of risk management, is quite poor, because the risk profile changes at every single new deposit, every single new withdrawal. And that's not what you want. Ideally, you want something that allocates, with a preset percentage to all those markets. And if one market is stressed, meaning there is no available liquidity, then the users only can withdraw a part of it. And that, I think, is a lot fairer and a lot more precise in terms of what should happen from a risk management perspective. But again, you have to manage it with business. And so the earn vaults don't do this. And so again, what is missing here? How do you price risk? And then that's why we like so much Cassa. Risk markets allow you to price risk, allow you to see through what's happening, allow you to judge the curator not based on how cool are their ads, how deep is their TVL, how high are their raw returns, but how good is the product in terms of risk-adjusted returns, which is quite exciting and again very compatible with this shift that we're seeing. If anything, I almost don't really see how we are able to build on this TradFi product without a risk infrastructure. Like we don't have credit default swaps on chain, we don't have options, we don't have all those tools that in traditional finance you're used to see. To understand risk and to trade it effectively. So yeah, sorry for plugging Cassa again here, but it just a natural convergence of all those thoughts around the direction the space is taking from you.
How do you approach risk from a systemic and quantitative perspective? Like, what are the variables that you're considering, given that many of the exploits, depegs, or losses in DeFi have often been of a much more exotic nature? It's not like a, aggregated fund of private credit and like there's a 30-year track record of delinquency rate, and you kind of have to calculate that in. And if a recession happens, maybe it's a little higher. The economy is booming, maybe it's a little lower. But in DeFi, it's everything is going well until suddenly there's some bug found in a smart contract, or like some very obscure economic exploit opportunity has been found. So how do you even quantify that? And like, if you have any resources to share, feel free to share your screen and walk us through.
Yes. Yeah, this is a great question. I would say we have some elements here. I think savvy users will be able to kind of understand more about our approach here if they read our research pieces. And we have some due diligence pieces coming out soon. Because of the smart contract risk, yeah, it's crazy. Like when you look at stuff like what happened to Balancer, it's very, very scary, right? Because you have some infrastructure that has been running for so long and has been audited so much time. How can you ensure that those new attack vectors are still taken into account? And yeah, when you have a protocol live, you need very rigorous procedures in terms of how you maintain this smart contract risk. There is no perfect way to abstract it, but I feel like those managed products that are so trendy now, thankfully, the smart contracts are quite simple. I cannot really recall major exploits around managed products with, code forked from like Etina or compatible with 4626. So if anything, the direction DeFi is taking now with a lot more of those managed products in terms of the smart contract risk is that it's a lot safer. There are also a lot of risks that we never really saw, like for example, at scale at least, right? L2 chains running on very permissions of validators colluding or potentially, keys being lost to a bridge or to a contract that holds a lot of funds. There was some FUD last year around this time about Hyperliquid being essentially, a 3 out of 5 multisig, if I'm not mistaken. We have not really seen this materialize. So it's really impossible to come to a precise, quantified assessment. I think each has their own. So now where the risk is a lot more is in the counterparty risk. And this risk is very real, because there is crime and humans will be, corrupted and do crime. I really like the approach that Stakehouse has to their managed products, because they plug on top of it Aragon DAO and they allow receipt token holders to make some of the decisions. This is very clever, but it doesn't work for every product out there. And also, again, it's an approach that doesn't make sense if you're just starting up. If you have, $100 million of TVL or $50 million of TVL in your product, it's just not worth it to do this. You cannot expect users to be actively involved in governance for those smaller products. But to echo what you're saying, it's very hard to do those kind of analyses. It's not sure that we have a I mean, it's quite sure that we do not have a perfect way to measure risk in the traditional sense. We just don't have enough track record. And again, the market shifts so quickly that your risk assumptions need to evolve. And again, that's very difficult. So you have to go with the flow. You have to be ready to. You always have to keep up to speed with what's happening. If you have small contracts, you should regularly re-audit them to ensure they are up to speed in terms of their security and not vulnerable to new attack vectors. If you have a managed product, you always need to make sure you're compliant, obviously, and that you're following best practices. Also, those evolve in the right direction. Now it's very clear, but last year it wasn't. That you need transparency around your product. I think you really cannot do without transparency ever when you're managing something, because then the counterparty risk increases exponentially. And finally, yes, obviously, in the realm of RWAs, there are products of very different categories. Some have a slightly higher yield, but they are a lot more degen. I don't think there is a lot of appetite for those in DeFi, but I still think that some folks will try to push them just because they're called RWAs and people don't entirely understand that it could be even more risky than some other managed strategies, etc.
What does the user journey for Casa look like? How can people get onboarded? How does the pricing of a risk work? And then ultimately, how do you make it tradable and liquid? So where in the entire stack of curation, vault management does Casa fit into? And how will it impact and benefit the day-to-day activities of other curators?
Yeah, that's a great question. The exact details of Casa are still a little bit private because it's a pre-seed project that's now closing a pre-seed round. But essentially, think of it as something that enables you to have a risk token that is liquid, that is composable, which value goes up if the perceived risk also increases. And then obviously, it needs to have some counterpart to that. But again, the goal really here is that the job for the curator does not become anymore, to find the highest yield, but to find the best yield after the market has charged you for the risk you're running. And this is a very, very big unlock. Also, a lot of curators have some skin in the game capital. I don't think there is any curator that really does not deploy any funds in their products. And thankfully so, right? Because it makes sense. If you do those products, if you believe in them, you will then also use them. But then I think a much better use of this capital is to underwrite the risks, of your products. Offer a way to kind of buy insurance, against the risk you're taking. Like this, I think you're offering a service to your users on top of what you're already doing, which is quite compelling, and this is also a service that institutional clients might be particularly sensitive to. Those are the ones with the most desirable kind and size of capital. You're offering them a new service. You're able to capture value if people are willing to buy insurance on your products and nothing happens, no risk event happen. This is value that goes into you. If I pay insurance for my car and I don't do any accident, I'm just paying for the insurance. It's to their benefit. And, this is value now that you're able to capture as a curator. And finally, maybe most importantly, based on the price of the risk token, I'm able as a curator to optimize not for the best raw returns, but for the best risk adjusted returns. If, say, I decide to make a change in my product and now the risk token is trading at a 25% discount, I know I'm optimizing for risk adjusted returns, which leads, to better, longer lasting products, which do not wreck the user. And yeah, I think this is really something that pushes the space forward. And it is quite exciting if you think about it. On the other hand, if you're a speculator, you believe, this product will blow up, you can just buy the risk token expecting that this price will increase. Now, if you think of policies for 1 year on other risk transfer solutions like Nexus, those usually go between 2, 3, 4, 5%. If risk increases, goes to 6, 7, 5, 8, 10, you kind of have doubled your money as a risk trader. So this is quite interesting. We've seen a little bit of it with Pendle, with yield trading, but the yield profile of yield markets on Pendle is usually quite established. There is maybe a little bit of volatility around inception, around maturity, but in between, there is not a lot of crazy, exciting things that happen. At least now in 2024, that was different, right? With Etina having 80% on PTs, right? This crazy stuff. But risk instead is a lot more volatile, especially if you attach it to private credit, especially if you attach it to earn vaults, which profile, again, let's remind ourselves, changes at every new allocation, every new withdrawal. So yeah, again, I think without revealing too much, this is what Casa plans to do and why we believe it's exciting for curators and users alike.
How do you see risk being traded and managed going forward? Is it more there are going to be very specific and insightful data dashboards and it doesn't really affect the underlying strategy? Do you think that there will be pricing mechanisms to make risk tradable and transferable, maybe through like any type of derivatives, options, prediction markets, etc.? And like, how is that going to facilitate the inflow of not only more capital but also more serious and more sticky capital that isn't changing strategies every other week as we've currently seen it at DeFi?
Yeah, so actually Casa makes risk tradable and visible. And if you are a quant firm that believes that they have a superior risk framework to price risk in DeFi than what the market currently thinks, no, you're actually able to use Casa to generate a lot of value for yourself. And maybe you'll become a reference in a way, and you'll be able to show that your assumptions and frameworks are the best ones in the industry. And certainly you want them to be proprietary, but you'll gain a lot of trust in the industry by essentially sharing those and I would say using Casa to show your expertise. Um, so yeah, to go back to your question earlier, is there a real way to quantify exactly the risk in DeFi? I think Casa is potentially leading to that. How is it allowing capital to be more sticky? I'm not sure I have an answer, but I think the kind of capital we're trying to onboard now, especially with those neobank exchanges integration, is one that's a little bit more sticky by nature, right? Because those are not necessarily users that know a lot of DeFi. Oftentimes, they're users that don't even have a wallet. They just go on the UI of their favorite bank and favorite credit card provider, and they put their idle funds to work. So this kind of capital I don't expect to be very mercenary, and that's maybe to the benefit of power users that need lenders to leverage their exposure, need lenders to guarantee liquidity in their markets. So I think money markets will compete in a very meaningful way for this capital, because again it's the most desirable one. It's not one that rotates easily. Once an integration is live on a chain, the exchange or the card provider will not have fun integrating a different money market and a different chain again. So yeah, I think we're going a little bit more in this.
I agree with you that like if we see more institutional, more TradFi capital moving on chain, it's going to be more sticky, less degenerate. So a lot of these yeah, annoyances in DeFi might decrease in the future. Hopefully they will. Yet right now we're still at a stage where there is a risk premium to be paid on top of traditional yield sources, because there are still like idiosyncratic risks to this industry and to that asset class and to this technology that cannot be eliminated from today to tomorrow. So on the side of yield sources and like the generating returns, how do you see that changing going forward? Which artists do you see suitable for yield generation, and where do you think that there's a lot of like hot air and empty hype?
Yeah, that's a great question. If there is one thing that the space likes, insatiable appetite for, that's yield and yield that scales. And I like that we're exploring new yield sources. So the cash carry trade, I think a lot of folks were running it before, but once it was tokenized, a lot of people realized that the value is not just in the trade itself, but in the fact that you're making it composable, especially with the sense that with all this capital coming in from lenders, now you can leverage essentially the spread and amplify your exposure in a way that's almost entirely risk-free. Like if we consider Etina loops, yes, sometimes the borrow rate turned a little bit in the disfavor of the looper, but overall, this has been for a few years quite a profitable strategy for many of the folks, even if you exclude the generous incentives. So obviously, yeah, now that we are in such a bad market, the carry trade is not as profitable as it used to be. So I see uh, again RWAs coming in. I also see other kind of arbitrage based trades. For example, recently we've been talking with a product called Main Street, which is using the box spread to bring yield on chain. They do it already with some leverage. This is a slightly more risky strategy for sure, one that's obviously not without some counterpart risk, but they seem to be know what they're doing. So this is also an interesting one, although I don't expect this strategy to be able to scale to the billions. Then yeah, I really like what Securitize is pushing with Karpatki on Euler. So stuff like VBill. I also really like what FraxUSD is doing, essentially bringing 3.9% yield in a cash equivalent form. Those are not numbers that are extremely exciting, but they are new yield sources. They're composable. They are safe. Again, now we are in a moment where the market is a lot more risk averse. So I don't expect a lot of DD and double digit products to come out and to attract a lot of capital.
Maybe besides your own strategies, are there any curators with any vaults and any underlying strategies that you personally like a lot, where you think there is a very good risk reward, and others where you would be a little more careful?
Well, if I did like every curator out there, I wouldn't have thought, there needs to be one more, and I wouldn't have decided we maybe need to start doing our own thing, right? So I think, I don't think there is one that matches perfectly how we think things should be done. But there are, I don't know, I really like a lot of things about a few. I think each has merit in a lot of things that they do. For example, Gauntlet has a fantastic BD team that's extremely detailed oriented. I think they're playing this game in a very, very smart way. Steakhouse has attached to the simple risk manager aspect a lot of very technically complex solutions. Like just yesterday, they announced a new 4626 solution that is very, very exciting. Allows you to do rebalancing operation inside a 4626 vault and allows receipt token holders to veto some of those operations. It's really crazy dev work. I'm very impressed by what they're doing. They also just did an app. I think that they're a bit of a reference, right, in this sense. They're doing a lot of very, very interesting things. So yeah, I would say those two, which by coincidence or not, are the largest, have all brought the space forward in some meaningful way. Yeah, those cover a segment of DeFi, which maybe does not really speak a lot to DeFi natives. The products are a little bit simple. I don't consider them particularly interesting for more advanced users, even institutional ones. So definitely what they're doing as a space, but getting up to borrow against the CBBTC for 3.4%, doesn't excite me very much. So while I certainly admit that there is a space for it, and that in terms of risk adjusted return, it's pretty down the risk ladder. It is something that caters to a lot of people. For me myself, what we're doing is not something that really excites us very much.
Agree a lot. Also fits into that entire, let's say, DeFi is dead, long live DeFi narrative that we have not seen pop up very explicitly over the past couple of months. But I do think that if you look at the change in ecosystem actors, participants, and who's partaking in the market, there are a lot of trends that are pointing at such thesis, because yields have compressed to such an extent where if you have size for many people, it is not really worthwhile sticking around compared to either like the desire to de-risk a bit in general, because all asset categories have been running super hot over the past couple of years, or you might be in an emerging country or have access to like strategies there that will yield you higher returns with a better risk adjustment. I think a main factor in kind of the declined excitement around DeFi is also that with the industry maturing, we have now finally gotten to a stage where we even understand the risks of it. Because in the past, it was a mere focus on returns. And I think still from like a retail participant's perspective, most of the things you can look at are just the advertised returns. You can use tools like DeFi Llama or Vaults.fyi to spot a divergence in the advertised returns and in the real returns. But on the risk side, especially if you look at whatever has emerged over the past 2 years with a lot of basis trades that have a centralized lag, or buying stuff OTC at a discount, a lot of the, let's say, tokenized hedge fund strategies or tokenized RWAs. If you look at the likes of USD AI, etc. I mean, of course, there are ways of attestation, and I would say that the majority of these companies are honest in what they are doing, but it still leaves you with an unanswered question of how to actually standardize and quantify these risks. Yeah, there is not that third-party trust vector that you could outsource to a bank or a private bank that you have in traditional finance, where you can kind of use them as a proxy. Okay, if their risk managers have looked at it, if they okay it, if they offer it to me as a client, I can use it to some likelihood as a proxy that this product and its underlying strategy is kind of all right. You still don't have that in DeFi. So yeah, how do you think this will evolve? And yeah, with what capital base and what returns are you calculating for the next couple of months? Are we going back
Yeah,
to complete degeneracy, or is it just a looped up treasury trade?
yeah. I mean, let's not forget that in traditional finance, blowouts do happen, right? And they tend to be quite spectacular. Also there. So it's not because you have someone to blame that that the risk completely goes away. You know, humans make mistakes, and there is again this counterparty risk that's present. I guess the difference is that sophisticated actors have the tools to hedge a little bit better against it, but it's still very very much there. And we've obviously tried to suppress it as much as possible with regulations or other things. But I don't think that because a large fund did not blow up in the last 2 years that we cannot completely discount this also being a problem in traditional finance as much as it is in DeFi, on different rails and with worse tools to hedge against it. In terms of exciting yield developments in the next 2 months, I really like to believe in the power of underwriting risk in something like Cassa. I'm going to share a slide from our deck. I think we are coming forward with some very, very exciting underwriting economics, because not only are you able to capture the value of policy premiums, which, as you can see already today on Nexus, range in this 2 to 5% risk, but you're also adding to that some yield bearing underlying. Pax USD yields 3.9%. It's a fantastic cash equivalent underlying for a risk market, I believe. You're also capturing risk trading fees. Now, this 2% number is actually taken from Pendle. But as I mentioned earlier, those yield markets are a lot less volatile than risk markets. So this is, I would say, quite conservative figure that still yields you double digits returns. And if you consider that you could be getting those while underwriting something, that's perceived very safe, as those markets with CB BTC as collateral, or other similar products. I think now underwriting is exciting. Now it makes sense. Wait a sec, so you're telling me that as an underwriter I can finally make more than the product that's there? Is this a little bit akin to risk crunching? Yes, but it also gives me pricing of risk, which is what I did not have until now. And these underwriting tokens that we are trying to build with Casa are composable. So same as PT tokens in Pendle make fantastic collateral for lending markets. I think we could see some of these being deployed out there. And so in terms of yield sources, I really like. I see as inevitable the birth of a risk infrastructure. Now, whether this will be us or others, it's obviously unclear, but it's inevitable. It's the missing layers. We have markets for leverage, we have markets for yield, and we don't have markets for what gets to decide whether you keep your money or not, which is risk. So it's inevitable some risk infrastructure will pop up, and in a very major way. Now, what I really like about Casa is that it fixes underwriting economics. It creates this credible path to organic, deep liquidity in risk markets. And so in terms of new yield sources in the next few months, I'm particularly excited about this one more than tokenized DG and private credits in an uncertain global market environment. Although I see a lot of interest for those tokenized equities, particularly the fact that you can also obviously long them on chain, but also potentially short them. And if you have enough demand for people shorting them, you have yield bearing stocks, which very, very exciting idea, right? They can have like SPY earning you yield on top of the fact that you can also leverage on top of it. I mean, that's really cool. Your interactive brokers does not entirely allow you to do that. So yeah, those are the things I'm looking forward in the next few weeks /
Since we're getting closer to the hour, any other topics or hot takes about the industry that you'd like to share?
I mean, we're definitely at a interesting point. I think I've maybe seen, in my life a couple of times people saying, oh, now the industry is dead. That's it. We're done for. I think we moved a little bit past that. I think we know that at worst, DeFi, will always have its niche. It will always serve, a certain set of users. And the fact that this, that the worst case scenario is moving up and up, I think it is very, very bullish. Even at our worst, we're not staking the survival of the industry as something that's up for grabs. So yeah, this is a very positive signal, one that is quite encouraging in a way that's maybe not the most exciting, but yeah, I think your audience is obviously one that's more of advanced users. So I don't think there is anything particular I can share about managed products that may interest you, other than the fact that it's again interesting to loop them, be in the lookout for this kind of more passive capital to come on chain and leverage opportunities. So our client use money. They have a senior tranche called SYZ USD, which personally I believe has very decent risk adjusted returns and has very generous liquidity being lent to it at rates that allow you to have a 2%, sometimes even 2.5% spread. So with a 7-8x leverage, this is quite compelling. Also, those are non-liquidatable loops because they involve hard-coded oracles. A lot of people think hard-coded oracles are bad. They're great. I mean, they do not serve all of the purposes, but for example, lending liquidity now is the name of the game. Before you had DEX liquidity and then downstream of that lending liquidity. Now that the roles have obviously reversed. So if your product is not liquid, you do not want your product to be priced based on what the market decides. You want it to be priced based on its value, on its solvency, right? This is a very important distinction. If not, it can be manipulated. If not, and there is an insolvency event, your losses actually materialize immediately. You do not get some recourse, potentially through legal means or through some off-chain procedures. So hard-coded oracles have a lot of merit in the sense that they allow to not wrecked users in case there is insolvency or solvency issues. Yeah, the next best thing is to have risk markets that are informed at maturity by solvency, and that's what we're doing in this Cassa. So if you want to follow us on X or follow me for updates, obviously this is something that's coming. Risk markets, risk pricing. Very excited about it. Looking forward to that, and I think something that your advanced users that follow us here will appreciate particularly.
Thanks a lot. We'll make sure to put all the links in the podcast description. And yeah, thanks for coming on. I think this was a quite interesting conversation about how like risk will move going forward in the DeFi and like on-chain asset management industry. I think this is an inevitably more important topic with more capital, more institutions coming on chain. And I do think that, yeah, if we want to have adult capital in the room, there has to be a more mature approach to all of this. We can't keep farming forked food perp dexes or whatnot at 100% APR into infinity. And yeah, while this certainly marks the end to absurd returns that we've seen in 2021 and 2022, I'm optimistic that new opportunities will emerge and yeah, gotta say on the frontier to capture them. Thanks a ton for coming on, Luca, and hopefully see you soon on the pod.
Looking forward. Have a good one.